Hi, everyone. Thursday, December 1st. Thank you for joining me for Three Things with Spyglass Lending, where we delve a little bit deeper into the mortgage and real estate industries, not your usual rigmarole. We're going to go and probe a little bit deeper. That's why we do it. Let's start with number one, right off the bat. You may have heard, because there's a lot of sources out there who wanted to tell you, the conforming and high balance conforming loan limits have officially risen, and these are the exact numbers heading into 2023. But what you heard already are probably just what you're seeing here on line number one. That's single family housing. So in 2022, you could see our numbers were 647,200 for conforming loan limits, and then the high balance conforming loan limit was 970,800. Well, what does that mean? Okay, conforming loan limits around the country. So if you had a loan less than 647,200, you fell within that category of getting the absolute easiest route to qualify for a mortgage, the best possible product, the lowest interest rate. But in places like Los Angeles, where prices are a lot higher, instead of 647,200, which is a little too low to qualify for, to have a loan limit, it's pushed all the way up to 970,800 before you leak into the jumbo space. And when you're in the jumbo space to qualify for those loan products, a much different animal, as we know. Well, heading into 2023, you can see it's risen pretty significantly again. So from 647,200, we're all the way up to 726,200 around the country. That's a pretty sizable jump. But specifically, over another $100,000 for that high balance loan limit from 970,800 all the way up to $1,089,300, and that bears worth watching. But again, we're delving a little bit deeper here, and what I'm showing here is 2, 3, and 4 units. And I think it's really worth noting, if you look down at the last line, 4 units, and head all the way over to the right, 2,095,200. That is if you want to buy a 4-unit. That is your new conforming loan limit, high balance conforming loan limit. I think that's pretty significant here in a place like Los Angeles, where a lot of people have given up on finding a single family home because it got too expensive. So what they're doing is house hacking. They're buying a 2, 3, or even 4-unit property, living in one of the units and renting out the others. And you can use either the leased rents that are already existing or even the market rents of those other units to help qualify to get the property. And obviously we know rental rates are so high. So if you're intending to live in one unit and rent out the other 3, you can qualify without leaking into the jumbo space on a 4-unit all the way up to $2.1 million here in California. That's something really to pay attention to. I'm glad we talked about it. Number 2, the Department of Real Estate just sent out an email yesterday to realtors and loan brokers like myself, giving an idea of all the bills that are going into effect January 1st, 2023. 2 of them in particular jump out at me. Let's start with the first one, AB 1837. This is a modification of something that you could see already existed all the way back from 2020. That was Bill 1079. And I'm going to read it real quickly to you. That allowed existing tenants, prospective owner-occupants, nonprofit organizations, and local governments, among others, up to 45 days after a home foreclosure auction to make an offer that meets the winning bid. Okay, so obviously what that means is, there were large institutions, investors, think iBuyers, think Blackstone-backed money, who were going in and making bids on foreclosure auctions, and they had to wait 45 days for these other, these owner occupants, nonprofit organizations, existing tenants to ultimately make an offer. But now the modification to this bill makes it even harder for these real estate investors, okay? Because it essentially disallows certain type of limited liability companies that were allowed to make these bids on these properties before, and it disqualifies all limited partnerships entirely from bidding to begin with. And that's pretty big. That's pretty big news. Again, limiting the scope of the iBuyers, limiting scope of real estate investors out there. But the big one is the one below, AB 2170. This is really big, and I'm going to read it here just so we get an idea of what it means. It provides now, instead of the 45 days after home foreclosure auction that you had to go in and match the bid, now it provides an initial 30-day window for eligible bidders to purchase properties acquired by lending institutions through foreclosure, also known as real estate owner REO. So you may have heard that term before, REO. What that means is a large financial institution, think Bank of America, when it goes through the foreclosure process, it goes first to notice a default, then notice a sale. It doesn't get bought at the trustee auction. It doesn't get bought at the courthouse steps, trustee or the auction. It goes all the way back to the bank. Now it's real estate owned. The bank owns it again, and they've got to get it off the books. This was obviously massive and a huge part of what happened back in after 2008, 2009, 2010. But this is requiring institutions that foreclose on 175 or more properties. Again, think Bank of America as well. They absolutely per year are going to foreclose on more than 175 properties. They can only accept offers in the first 30 days from prospective owner occupants, qualified nonprofits, government entities, or other affordable housing providers. Okay. And it also requires these institutions to respond to each in writing. It prohibits institution from completing a bundled sale of more than one foreclosed property. That is massive because what was happening previously is tape REO. Tape REO means that REO, real estate owned, again, the financial institutions had this in bundles and they would sell it in tape. They'd sell it by the dozens to hundreds to the iBuyers or Blackstone backed money or other investors out there who were picking up these properties because they wanted to put in a portfolio for rentals. Now, you can't just do that anymore. They don't want that happening here in the state of California. They want it. They want each individual property really going to owner occupants or government agencies or the tenants before any of these massive real estate investment companies or these iBuyers have their chance to pick that up. That's really worth watching. And I think also worth watching, as always, number 3 here on the list, what's going on with housing starts? What's happening with construction? Well, October, another pretty precipitous decline, 4.2% month over month, but specifically in the residential space, 6.1%, over 6% decline from the previous month. That's not small. And again, if you want to look a little closer and see the chart at the bottom here, what it's telling you is at the end of 2021 or beginning of 2022, even though it was still woefully light because the inventory is still, it has not being met out there, you were having over 1.7, even over 1.8 million in housing starts across the country as early as April. Then a really big decline when inflation hit and interest rates were starting to rise. So you saw that jump down, excuse me, in May and June, but specifically by July, we were all the way down to 1.377 million housing starts. And then there was kind of a tick back up in August. But again, we're seeing this precipitous decline again in September. And now here we are we just got the October numbers at 1.425 million and over 6% on the residential, decline in residential housing starts. Again, inflation, the cost of doing construction, and what is on the horizon economically has builders a little scared to even begin doing the process. And that is worth noting. Again, we are still in a massive inventory shortage out there, and yet builders are going the other direction from actually building. And as we head into 2023, that's really one of the leading economic indicators we all want to be paying attention to. Thank you for joining me. This has been 3 Things with Spyglass Lending, where we probe a little bit deeper in the mortgage and real estate industries. Join me again next Thursday. We'll do it all again. Thank you.